Welcome back to the Deep Dive. We're here to give you that shortcut, that edge, to being really well informed.
And today, we're diving deep into something pretty significant in the CPG world. It's the Q3 2025 earnings call for Oatly Group AB, stock ticker OTLY, for those following along.
Right, and this isn't the whole call, mind you. We're focusing laser-like, really, just on the opening remarks from the CEO. That's Jean-Christophe Flatin, or JC.
Exactly. We're using the official transcript, but stripping it down to his high-level view, his strategic overview, the key milestones he wanted everyone to hear right off the bat.
And the mission here, well, it's pretty clear. Oatly had this, rapid growth story post-IPO, but it came with huge costs, lots of red ink quarter after quarter.
Yeah, burning cash.
Exactly. So now we're digging into the moment the CEO says that changed. He's claiming a shift to profitable growth.
So we need to unpack that. What numbers back it up? What specific strategies did he point to? What does this turnaround story really mean?
It's about more than just Oatly, isn't it? It's kind of a test case for these big mission-driven brands trying to make that leap from high-growth startup to, well, a sustainable business.
A mature, profitable company. It's moving past just wanting growth to actually executing it profitably. That's the nut we need to crack today.
Okay, let's do it. Section 1, the big headline, the profitability milestone. Where did JC start?
He started right at the top. The main takeaway he wanted lodged in everyone's mind. For the first time since the IPO, Oatly drove, and this is his term, profitable growth in the quarter.
Profitable growth. Okay, that term gets thrown around a lot.
Yeah.
How did he define it for Oatly in Q3? What does it actually mean in their context?
He pinned it on two things specifically. One, solid constant currency revenue growth, and two, positive adjusted EBITDA.
Okay, let's break those down. Constant currency revenue growth first. Why is that specific wording important?
It's crucial because it means they're taking out the noise from fluctuating exchange rates.
Yeah.
The dollar versus the euro or the yuan.
All right, so it shows the growth is coming from actually selling more stuff, more volume, more market penetration, not just getting lucky with currency movement.
Precisely. For a global player like Oatly, that's key. It shows genuine underlying demand, which is what you want to see.
Makes sense. And the second part, positive adjusted EBITDA.
Yeah, adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization. It's a measure of core operational profitability.
So before all the accounting adjustments and financing costs, the basic business of making and selling oat milk actually made money in the quarter.
That's the idea. It means they covered their day-to-day operating costs from the revenue they generated. For a company that, let's be honest, was known for burning through cash to fund its growth.
Yeah, the cash burn narrative was huge.
Exactly. Hitting positive adjusted EBITDA, even adjusted, that's a major signal flare. It suggests the underlying unit economics might finally be working. The narrative potentially shifts from, are they going to run out of money, to, okay, can they sustain this?
That's a massive shift for investors, for the market perception. But you mentioned he was careful with his language. He didn't exactly declare mission accomplished, did he?
Oh, absolutely not. Very deliberate framing. He stressed quite emphatically that this is not the finish line.
Right.
He called it a marker of progress and a crucial credibility milestone.
Credibility, that feels important.
Yes.
They needed to prove they could do it.
Yes. And he framed it as a ramp up for future profitable growth. So think of it like base camp, not the summit.
Wow.
It manages expectations. It says, look, our plan is working. This is proof, but we're sticking to the plan. There's more to do.
Okay, that makes sense.
Yeah.
Managing expectations, building trust after maybe, some bumps in the road. So to hammer this home, he laid out 3 key messages right at the start.
Yep. 3 main takeaways. First, obviously, the headline, profitable growth achieved, driven by that revenue growth, and positive adjusted EBITDA. Simple statement of fact.
Yeah.
Second message was strategic. He said there are clear signs that the refreshed growth playbook is working. This wasn't just about cutting costs. It was proving the new strategy is actually driving positive momentum in the markets where they've deployed it.
The playbook. We'll definitely need to dig into what that actually involves later. But the point here is it's not just theory, it's showing results.
Exactly. It connects the financial outcome to the strategic actions. And the third message.
Let me guess. Something about the future. Guidance.
You got it. Reaffirming the full year 2025 guidance. Even with this good quarter, they're sticking to their existing targets for the year.
So, no getting carried away by one good quarter. Disciplined. Predictable. That sounds like the kind of maturity the market wants to see from them now.
That's precisely the signal. Control, predictability, sticking to the plan. It all points towards building that credibility he mentioned.
Okay, so that sets the stage. Profitability achieved, but framed as just the start, linked to a new strategy, and with a commitment to staying disciplined. This naturally leads us to understand how they got here. What's the story behind this turnaround?
Right, this wasn't an overnight success story. JC was very clear that this Q3 result stems from disciplined strategic actions they've been taking over the past 3 years. It's about strengthening the foundations of the business.
And he marked a specific starting point for this real strategic shift, didn't he?
He did, mid-2022. That's when he and Daniel Ordonez came into the leadership team. He presented the results since then as evidence of a pretty fundamental overhaul.
Okay, let's get into those numbers because they paint a really stark picture of change. What did he highlight on the sales side since mid-2022?
Sales up, over 20% increase in sales since that mid-2022 point, which, for a company already at significant scale, maintaining that kind of growth is pretty solid.
Solid, yeah. But the real story, the jaw dropper maybe, is what happened on the cost side simultaneously, right?
Right, exactly. This is where the operational discipline really shines through. While growing sales by 20%, they managed to cut their cost of goods, sold KGS per liter by over 25%.
Okay, hold on. KGS per liter down 25%. Let's unpack that. KGS is the basic cost of making the product, right? The oats, the water, running the factories, the packaging.
Everything that goes directly into producing that carton of oat milk.
So how do you slash that fundamental unit cost by a quarter while increasing the amount you're selling? That seems incredibly difficult. What levers are we talking about?
It implies a massive effort. It's not just tweaking things. A 25% drop suggests several big moves. First, you'd have to assume major supply chain work. Negotiating better prices for raw materials like oats, maybe centralizing procurement to leverage their global scale.
Okay, getting better deals on inputs? Makes sense.
Second, and probably even more significantly, it points to huge gains in manufacturing efficiency, optimizing their factory network.
Oatly built a lot of factories, sometimes maybe ahead of demand. That was part of the old growth story.
Right. Hypergrowth often means building capacity fast, which isn't always efficient initially. So this 25% reduction strongly suggests they've gotten much, much better at running those plants. Higher utilization rates.
Meaning the machines are running more often, producing more liters per hour, less downtime.
Exactly. Spreading those fixed costs, the rent, the energy, the maintenance, over more volume, that directly lowers the cost per liter. It might also mean they consolidated production, maybe closed less efficient plants, really focused on throughput. This is deep operational engineering level work.
Wow. Okay, so supply chain optimization and manufacturing excellence driving down KGS.
Yeah.
But the cost cutting didn't stop there, did it? He mentioned SG&A too.
Correct. Selling, general, and administrative expenses, SG&A, also down by over 25% since mid-2022.
And SG&A is, well, everything else, pretty much. Corporate salaries, rent for offices, IT, marketing budgets, sales team costs.
All of that, the overhead. Cutting SG&A by 25% while growing revenue by 20%. That's the hallmark of shifting from a, let's say, slightly chaotic, growth-at-all-costs startup mode to a much leaner, more efficient corporate structure.
So what does that look like practically? Fewer layers of management, tighter travel budgets, making their advertising spend work harder?
All of the above, most likely. Streamlining back-office functions, maybe shared services, definitely more scrutiny on marketing ROI, getting more bang for their buck, as they say. It suggests a company-wide focus on eliminating waste and redundancy.
I have to play devil's advocate for a second here. A 25% cut in KGS and a 25% cut in SG&A in just 3 years.
Yeah.
That's aggressive. How do we know this is sustainable efficiency versus, say, cutting too deep, cutting muscle along with fat? Or maybe just eliminating some one-off costs from the past?
Well, that's always the critical question with turnarounds, isn't it?
Yeah.
Sustainability. JC tried to address this directly in his framing. He talked about it being a company-wide effort.
Implying a cultural shift, not just top-down directives.
Yes. He said the results came from operating smarter, serving customers better, and positioning the company for sustained success. The language aims to convey these are structural improvements, better processes, smarter systems, more strategic resource allocation, not just temporary belt-tightening.
So the argument is, if they truly improved factory utilization, streamlined their supply chain, made marketing more effective, those should be sustainable gains.
That's the argument. And it leads right into this core philosophy JC talked about, which kind of underpins this whole effort, the balance between performance and purpose.
Ah, yes, the Oatly mission. They're probably one of the most visible, purpose-driven brands out there. built on sustainability and climate impact.
Absolutely. And for a long time, the critique, or maybe the question, was whether that strong mission came with a purpose tax, higher costs necessary to fulfill the mission.
All right, could they be both deeply mission-oriented and financially disciplined?
And achieving this profitable growth, JC argues, is the validation. It's proof that, yes, they can do both, that performance and purpose aren't mutually exclusive.
In fact, maybe the discipline needed to build a truly sustainable, efficient global operation drives the financial performance we're now seeing.
That's a really interesting way to put it, and I think that's implicit in his message. He's stated pretty clearly that these actions have put them on a path towards durable, scalable, and profitable growth. This Q3 result is the proof point, the tangible evidence that the team can manage that GOOL mandate effectively. It builds confidence, internally and externally.
Okay, so the foundation is laid. Intense operational discipline, driving down costs, combined with the belief that this actually strengthens, not weakens, their purpose-driven model. Now let's talk about how they plan to keep the growth side of the equation going with this newfound efficiency, the refreshed growth playbook.
Right, so you've got the cost structure under control. Now, how do you drive the top line, the revenue, in a smart, profitable way? That's where this refreshed growth playbook comes in. And JC was keen to provide evidence that it's already working.
Where did he point for the clear signs of success?
Primarily to their Europe and international segment, the E&I segment. They started rolling out this new playbook earlier there, kicking off last year.
And the results are showing.
Definitely. He highlighted Q3 revenue growth in E&I of over 12%. That's pretty strong, especially for some of those more mature European markets.
Yeah, 12% growth is good, but does it align with the profitable growth narrative?
Yes, and that's the key validation. The E&I segment didn't just grow sales, it delivered an 18% adjusted EBITDA margin in Q3. That's a big jump, 700 basis points or 7 percentage points higher than the same quarter last year.
Wow, okay. So higher sales and significantly better margins in the region where the playbook has been active longer, that does sound like validation.
It shows they're leveraging that improved cost base effectively as sales increase. It's not just growth, it's high quality, profitable growth.
So what is this playbook exactly? He mentioned pillars like driving relevance, attacking conversion barriers, increasing availability. That sounds a bit like standard marketing speak. What's the Oatly twist? How are they actually doing it on the ground?
Yeah, the terms themselves are broad, but the execution seems highly specific, almost surgical. It revolves around tackling the biggest hurdle for plant-based alternatives: taste, perception, and trial.
Getting people to try it and like it enough to switch or incorporate it.
Exactly. And they figured the best place to win that battle isn't necessarily the supermarket aisle initially. It's somewhere with a curated experience, expert preparation, and a focus on flavor.
Ah, the coffee shop.
Bingo.
Yeah.
The food service channel, cafes, coffee bars, that's the tip of the spear for this playbook.
So leveraging baristas.
Heavily. They have these specialist teams. He mentioned over 60 barista market developers globally. Their job isn't just selling cases of Oatly Barista Edition, it's embedding Oatly into the culture of that coffee shop.
Training. Collaborating on drinks.
Both. Thousands of hours spent training baristas on how Oatly performs, how it steams, how it tastes. But more than that, co-developing new drinks where Oatly isn't just a substitute for dairy, but a key ingredient that enables a specific, desirable flavor profile.
Interesting. So moving beyond just swap milk for oat milk to this drink is amazing because it uses Oatly.
Precisely. He gave the example of their new matcha oat drink becoming super popular. It's about making Oatly the default experience canvas, as he put it, for the kind of drinks that Gen Z and younger consumers are actively seeking out. Think specialty lattes, cold brews, innovative flavor combinations.
That makes Oatly relevant, not just an alternative. It's part of the trend.
Right, that's the driving relevance pillar, and it directly attacks the conversion barrier. If you try an amazing, complex, delicious coffee or matcha drink at your favorite cafe and find out it's made with Oatly, that positive taste experience is incredibly powerful. It overcomes skepticism.
And that positive experience presumably leads people to then look for it in stores for home use.
That's the increasing availability link. The playbook operates like a cascade. Win in food service first, create positive taste experiences and buzz, and then retail demand follows as converted consumers want to replicate that experience or use the product more broadly.
Did the numbers back up that cascade effect in Europe?
They did. In the E&I segment, food service growth hit 28% year-on-year. Retail growth then accelerated afterwards, reaching 11%. He specifically called out Germany as a prime example.
What happened in Germany?
5 straight quarters of food service growth exceeding 45%, just massive momentum in cafes. And following that, retail sales accelerated, showing over 14% growth in the latest 12-week data. It shows the playbook working exactly as designed. Food service leads, retail follows.
Okay, that's compelling for Europe. What about North America? That market's always been a bit tougher for them, hasn't it? More complex retail landscape, different consumer habits, maybe?
It has been tougher, and they acknowledge that. Momentum is slower in North America, but he said they are seeing positive signs, early progress. And crucially, that progress is showing up first, guess where?
In the food service channel.
Exactly, in food service, even with some specific headwinds they faced in North America, like a change with a large customer's sourcing and getting rid of some less popular frozen products.
Right, some specific issues dragging overall numbers down a bit.
Even with those issues, North American food service still grew 11% in the quarter if you adjust for that one large customer change.
So 11% growth in that key starting channel, food service, despite other challenges. That suggests the core mechanism winning taste perception in cafes is working in the U.S. too, just maybe taking longer to flow through to the broader market.
That seems to be the interpretation. The underlying consumer trends interest in new flavors, the shift from hot to cold coffee drinks where oat milk often shines, those are global. The U.S. execution might just take more time due to market structure.
But the fact that the starting point, food service, is showing growth gives them confidence in the strategy itself.
Clearly, JC stated they're pleased with the initial progress across the board and plan to double down on the execution of our strategy. They see the E&I success as proof it works, and they're committed to rolling it out more aggressively, presumably focusing resources on North America now.
Okay, so playbook validation seems key. It connects the cost cuts to a viable, profitable growth strategy. But even with this playbook success, they kept the full-year forecast quite conservative, didn't they?
Extremely conservative, yes. And that ties back to the credibility point we discussed earlier. Hitting the profitability milestone in Q3 was huge, but they immediately tempered any potential overexcitement by reaffirming the existing full-year guidance for 2025.
No victory laps yet.
No. It signals discipline. It says, we had a good quarter, things are working, but we're sticking to our long-term, structurally sound targets. It avoids the perception that they're reactive or basing forecasts on a single data point.
Let's look at those reaffirmed numbers again. Constant currency revenue growth expected to be basically flat, approximately flat to 1% for the whole year.
Yeah, flat to 1%.
Given the momentum we just discussed, 12% in E&I, the overall 20% growth since mid-2022, why such a low full-year number? Does that hint at underlying weakness we're not seeing, maybe outside of Europe or in specific product lines?
It's a fair question, and it definitely signals caution. The flatness likely reflects a couple of things. First, those North American headwinds are real. The customer change, the SKU cleanup, those are dragging down the full-year average, even if food service is picking up.
Okay, so some specific drexy.
Second, and maybe more strategically important, it reflects their focus on profitable growth above all else right now. They seem willing to walk away from lower margin volume if it doesn't fit the new playbook or drags down overall profitability.
So they might be deliberately not chasing certain sales if the margins aren't there, prioritizing quality of revenue over quantity.
That seems to be the implication. That flat to 1% growth forecast says we're focused on making sure the growth we do get is high quality, sustainable, and profitable, even if it means the overall top-line number looks modest for 2025. It aligns with building that durable foundation.
Okay, that makes strategic sense. And the adjusted EBITDA forecast reflects that caution too.
It does. Still targeting $5 million to $15 million for the full year. And interestingly, during the analyst Q&A part of the call, which we're not diving deep into, but is context, they hinted they'd likely land in the lower half of that range.
Really? So even more caution baked in, recognizing it still costs money to implement this playbook, especially in North America.
Exactly. It acknowledges ongoing investments are needed, challenges remain, and they're not getting ahead of themselves. And the final piece of that puzzle is CapEx, capital expenditures.
How much are they planning to spend on new equipment, factories, etc.?
Only about $20 million for the full year.
That seems incredibly low for a global CPG company with manufacturing plants all over the world.
It's very lean, And it strongly reinforces the message that the era of massive investment in building out capacity is over, for now at least. The focus is entirely on optimizing the assets they already have, sweating those factories, making them run efficiently.
Right. Maximize returns on existing investments.
So the CEO basically summed up the forward plan as the winning recipe. Keep rolling out the playbook, channel by channel, market by market, with intense focus and discipline, while simultaneously maintaining that tight grip on costs. Drive demand smartly through food service, let it flow to retail, and ensure every step is profitable.
A clear, disciplined approach. Now, there was one other major strategic piece discussed, something potentially transformative for the company structure, the Greater China Review.
Yes, that's a big one. The Greater China business is under strategic review. It's important to note, JC stressed that the business itself, the team on the ground there, they continue to perform well.
So it's not under review because it's failing.
Quite the opposite, actually.
Oh.
He highlighted that China also drove strong, profitable growth in Q3. Food service, which is the biggest piece of their China business, grew 18% in the quarter.
Okay, so China is performing well, profitable, growing. Why the strategic review then? Why consider changing things?
It boils down to maximizing value and potentially simplifying the overall structure of Oatly Group. China is a unique market, massive potential, but also distinct operational challenges, regulatory landscape, competitive dynamics.
Very different from Europe or North America.
Very different. So the review is looking at a range of options to best accelerate growth and maximize the value of that China business. And the key phrase he used was the potential for a carve-out.
A carve-out, meaning spinning off the China operations into a separate entity.
Essentially, yes. Creating a distinct legal and financial structure for Oatly China. This could involve bringing in local partners, attracting capital specifically focused on the China market opportunity.
Why would they do that if it's already profitable?
Several potential reasons. It could unlock value. Maybe investors focused purely on China would value that specific entity higher than it's currently valued as part of the global group. It could allow for more tailored, faster decision-making suited to the local market. It might attract strategic partners with deep regional expertise.
And maybe it simplifies the story for the main Oatly, OTLY stock. Investors could focus on the E&I and North America turnaround without worrying about the complexities or perceived risks of the China market weighing on the overall valuation.
That's often a major driver for carve-outs, yes. It allows each part of the business to be valued and managed according to its specific context and potential. The goal, as JC put it, is accelerating growth and maximizing value.
But he was also clear they weren't pulling out of China.
Right. Absolutely clear on that. He emphasized their commitment to operating in the region, including keeping the Ma'anshan manufacturing facility running. The review is about the ownership structure and capitalization, not about abandoning the market.
So ensuring continuity for customers, consumers, employees there, regardless of the potential structural change.
Exactly. They see the future potential. They just want to find the best structure to realize it. It's another layer of that disciplined, strategic thinking applied now not just to operations, but to corporate structure itself.
Okay, it really does paint a picture of a company systematically addressing every facet of its business, from the cost per liter up to the optimal structure for its international segments. #outro.
So if we wrap this all up, what are the key things you, the listener, should really take away from JC Flatten's view of Oatly's Q3? The big narrative is definitely that shift from, somewhat unrestrained growth post-IPO to a much more disciplined, efficiency-focused scaling model.
Yeah, and the numbers that define that shift are pretty stark and worth remembering. Sales up over 20% since mid-2022. That's the growth part.
Right.
But simultaneously, COGS per liter and total SG&A both slashed by over 25%. That's the efficiency engine.
Right. That operational rigor is what delivered the profitability milestone in Q3, and that milestone, crucially, isn't being treated as the end goal.
No, it's the launch pad, right? The marker of progress, the proof point that allows them to confidently pursue future scalable and durable growth. It validates that maybe performance and purpose really can go hand in hand if the execution is disciplined enough.
And the engine for that future growth is clearly defined, this refreshed growth playbook, heavily reliant on winning in the food service channel first, using coffee shops and barista culture to drive relevance, tackle taste concerns, and build demand that then flows into retail.
That reliance on food service, the coffee shop strategy, it does bring up a final, maybe provocative thought for us to leave you with.
Go on.
Well, the CEO highlighted how critical those 60-plus barista market developers are, embedding Oatly in cafes, driving those localized flavor trends, like the matcha drink example. It's a very high-touch, almost artisanal approach to market
It
development.
is very focused.
So the question is, as they try to scale this playbook, especially across a market as huge, fragmented, and complex as North America, how sustainable is that high-touch model? Can they really replicate that deep engagement widely enough? Does Oatly's path to consistent, scalable profitability really depend on effectively turning thousands of coffee shops into localized brand incubators?
That's a great question. Can that specific playbook scale efficiently across vastly different regions and consumer segments?
And maybe stepping back even further, what is this whole Oatly turnaround story? The intense focus on operational discipline, the specific channel strategy. What lesson does it offer for all the other purpose-driven brands out there? Brands trying to make that tough transition from being a cool, mission-led startup to a truly viable, financially sound, long-term enterprise.
Yeah, is this level of ruthless efficiency and strategic focus the necessary price of admission for purpose-driven brands to succeed at scale in today's market?
Something definitely worth thinking about. That brings us to the end of this deep dive into Oatly's Q3 2025 CEO remarks.
Thanks for joining us. We hope this breakdown gives you a clearer picture of the mechanics behind this significant corporate shift. Keep digging, keep questioning.